Welcome back to the Daily Crypto Deep Dive. Ethereum is supposed to be the safest bet in crypto right now. It's the institutional favorite, the backbone of decentralized finance, the network that everything seems to run on. But what if that narrative is starting to crack? What if Ethereum isn't undervalued heading into the next cycle, but actually overvalued, and the biggest players in the market already know it? Because right now, beneath the surface of bullish headlines and ETF speculation, there are some uncomfortable questions starting to emerge. Questions about scalability, about centralization, about competition, and most importantly, about whether Ethereum's current valuation actually reflects its real position in the market. And today, we're going to break that down properly. Not the hype version, not the surface-level Ethereum to the moon narrative, but the deeper, more nuanced view that institutions, analysts, and serious investors are quietly discussing behind the scenes. Because if Ethereum is priced for perfection, then even small cracks can have big consequences. Let's start with the narrative that's driving everything right now. Ethereum has become the institutional crypto asset. Bitcoin is seen as digital gold, a store of value, something you hold. But Ethereum is being positioned as something different. A yield-bearing asset, a programmable financial layer, a platform that institutions can actually build on. And that shift is important, because it's not just about price anymore. It's about utility, infrastructure, and long-term positioning in a new financial system. You've got growing discussion around Ethereum ETFs that include staking. You've got funds exploring ways to generate yield through Ethereum exposure. And you've got a broader narrative forming that Ethereum could become a core part of institutional portfolios. Analysts like Chris Berniski have spoken about this shift, highlighting how Ethereum sits at the center of what he calls the crypto financial stack. The idea is that Ethereum isn't just another asset, it's infrastructure. And infrastructure, in theory, deserves a premium valuation. But here's the problem. That valuation is already here. Ethereum isn't being priced as a risky emerging technology anymore. It's being priced as if it has already won. And that's where things start to get uncomfortable. Because when an asset is priced for perfection, it doesn't take much to break the narrative. Now let's talk about scalability, because this is one of the biggest structural challenges Ethereum still faces. Ethereum has spent years trying to solve its scaling problem. High fees, slow transaction speeds, network congestion. These have been consistent issues during periods of high demand. The solution has been Layer 2 networks, rollups, sidechains, scaling solutions built on top of Ethereum to handle transactions more efficiently. On paper, this works. But in reality, it creates fragmentation. Instead of one unified network, you now have multiple layers, each with their own ecosystems, liquidity pools, and user experiences. And for new users, this can be confusing. Bridging assets, managing wallets, understanding different layers. It adds complexity. And complexity is friction. Arthur Hayes has pointed this out before, that while Ethereum is incredibly powerful, it's not always the most user-friendly system. And in a competitive market, user experience matters. Because while Ethereum has been building out Layer 2 solutions, other chains have taken a different approach. Solana, for example, focuses on high throughput at the base layer, faster transactions, lower fees, simpler user experience. Now that comes with trade-offs, decentralization, reliability, network outages. But from a pure usability perspective, it's attractive. And this is where competition starts to matter, because Ethereum is no longer the only game in town. Cardano, Solana, Avalanche, and others are all competing for the same space: developers, users, capital. And while Ethereum still has the largest ecosystem, dominance is not guaranteed. Markets change, technology evolves, and narratives shift faster than people expect. Now let's talk about staking, because this is another key part of the Ethereum story. Staking is often presented as a positive. And it is, in many ways. It allows holders to earn yield, it secures the network, and it creates an additional incentive to hold. But it also introduces new dynamics. One of the biggest concerns is centralization. A significant portion of Ethereum staking is concentrated in a few large entities. Platforms like Lido dominate the staking landscape, controlling a large percentage of staked Ethereum. And that concentration creates risk, because if too much control is held by too few players, it starts to challenge the decentralization narrative that crypto is built on. This is something that analysts like Lyn Alden have touched on. The idea that systems designed to be decentralized can still drift toward centralization over time, especially when economic incentives are involved. And when institutions enter the space, that effect can accelerate. Because institutions don't operate like retail investors. They allocate capital at scale. They use custodians. They rely on large providers, which means capital flows tend to concentrate. And that concentration can reshape the network. Now let's bring valuation back into the picture. Ethereum's current valuation assumes continued dominance. It assumes that Layer 2 scaling will work seamlessly. That competition won't significantly erode market share. That staking will remain attractive. That institutional demand will continue to grow. That's a lot of assumptions. And in markets, assumptions are where risk lives. Because if even one of those assumptions starts to fail, the narrative weakens. Chris Burniske has spoken about valuation cycles in crypto, noting that assets often become overextended when narratives run ahead of fundamentals. And when that happens, corrections can be sharp. Arthur Hayes has been even more direct at times, warning that markets can become complacent during periods of strong narrative alignment. And right now, Ethereum has one of the strongest narratives in the entire market, which makes it powerful, but also vulnerable. Now let's look at the institutional angle, because this is where things get really interesting. Institutions are not emotional. They don't buy into narratives the same way retail does. They look at risk, return, and positioning. And while Ethereum is attractive, it's not the only option. If alternative chains continue to improve, if user experience becomes a deciding factor, if fees remain a concern, institutions will adapt. Capital moves. It doesn't stay loyal to a narrative. So the question becomes, are institutions fully committed to Ethereum long-term, or are they simply positioned there for now? Because those are two very different things. Now, to be clear, none of this means Ethereum is going to fail. This is not a Ethereum is dead argument. Far from it. Ethereum remains one of the most important assets in the entire crypto space. Its ecosystem, developer base, and network effects are incredibly strong. But strength doesn't mean invulnerability. And that's the key point here. Ethereum doesn't need to fail for its valuation to be challenged. It just needs to underperform expectations. And when an asset is priced for perfection, even small disappointments can have outsized effects on price. So where does that leave us? Right now, Ethereum sits at the center of the crypto market. It has the narrative. It has the institutional interest. It has the infrastructure. But it also has questions. Questions about scalability. Questions about competition. Questions about centralization. And questions about whether its current valuation truly reflects the risks involved. And those questions matter. Because markets are forward-looking. They don't price what is happening now. They price what is expected to happen next. So if expectations are too high, the market can correct even if the asset itself is still fundamentally strong. That's how markets work. That's how cycles play out. And that's why this conversation matters. Because it's easy to follow the dominant narrative. It's easy to assume that the biggest, most talked about asset is also the safest. But sometimes, the biggest risk is the one nobody is questioning. So the real question is this. Is Ethereum still undervalued heading into the next cycle? Or is it already priced for a future that hasn't happened yet? That's what investors need to think about. Because the answer to that question could define the next phase of the market. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.